So it's still doing something like the will strategy when you're selling just the naked put, but when you sell the just the naked put, you only have what you can make on that put that you sold. But if you turn it into what we call the Bionic Bull and buy that call for free because someone's paying you some monies and you take some of that to buy the call, then you can have unlimited upside when you do this kind of Bionic Bull. Let's discuss the will strategy. Let's discuss upgrading the will strategy.
Please subscribe to our channel. Have fun trading!
And if you're not familiar with the will strategy, it consists of two types of trades. The first trade is the selling of the naked put. And the second trade, if you are assigned shares, if you sold the naked put, then you do what is called a covered call. And with the will strategy, you usually start almost 100% of the time. You start with the selling of the naked put. You don't start with the covered call. I don't know why. You could start with the covered call, and we'll talk about that here in a second when we go over the safeguard strategy, what we call the safeguard strategy, which we believe is an upgrade to the will strategy. And we're going to use Walmart as an example because we're actually going to execute a part of a will strategy or part of the safeguard strategy on Walmart this morning. So let's break down the kind of setup of a will strategy. You can do it on an index, you can do it on any type of stock, but what I like to do the will strategy on is on dividend aristocrats. Companies that have been around for at least 25 years, have paid a dividend for at least 25 years, and has raised their dividend for at least 25 years straight. And Walmart is one of those companies. It's one of those companies that is just a safe haven. It's when the market starts to tumble, when people start to get afraid, Walmart is one of those companies that people gravitate to. Right? They gravitate to because when the economy is going bad, people are still going to be buying or shopping at Walmart. They might even get more consumers, more customers coming from other type of retailers like Target. Target is a little bit more high end than Walmart, so some of those shoppers might come to them when things are starting to go poorly. You can see that when the market is going well, sometimes companies like Walmart or some of these dividend aristocrats underperform to some degree. You can see that that's happening today with this company because people when people stop being scared, they start getting greedy, and then they want to go to the high flyers. They want to go to those tech companies. They want to see things go up 50, 60, 70% in a short period of time. Right? And that's fine, but you have to realize that those things can also fall 50, 70% in a short period of time. But you're not going to experience that kind of stuff with almost all, if not all, the dividend aristocrats. They're just too safe, and they're too steady, and definitely Walmart is in that case. But let's just say you wanted to trade the will strategy on this, like I like to, and you can do it with the weeklies because their options are super robust, or you can do something monthly. But usually the will strategy is trying to make some income monthly on a monthly basis. But with the safeguard strategy, you can do it on a weekly basis or you can do it on a monthly basis. Let's look at them both really quickly. Okay? So let's say we wanted to go 7 days out. And if you're going to do the will strategy, traditional one, you're going to sell the naked put first. So if you sold this naked put at the money, basically at this 150, you would collect $112, and your cost basis would be around just under 149 at 148.88. And so just around here, this would be your cost base if you sold this naked put. Someone would pay you $112 to sell this option to them. And if the option stays above 150, then you're going to make the entire $112. You get to keep that entire $112. If it drops below 150, then you will start losing once it goes a little bit under 149. Okay, a little bit under 149, you'll start losing. But if it stays between 149 and 150, you're still going to make something. You're not going to make the 112, but you're still going to make something. And this is an attractive way to start the process of owning shares in something that you like, because you're going to always be able to get it for a discount. In this example, instead of paying $150.21 for the actual shares for the going price right now, you're going to get it at a cost basis of just under 149. So you're getting it for a discount. You're always going to get it for a discount if you initiate the will strategy with the naked put. Okay? You can also decide to go further away. You can say, okay, I don't want 112 in this next week. I'm okay with $80, or I'm okay with 55, $56. You can decide where you want to sell that naked put. You can even do it in the money. A lot of times the wheel strategy is not about doing it in the money, selling to put in the money. But let's just say you really think Walmart was going to go up and you want to get it for a discount still, but you're going to sell it in the money so you can have a higher probability of being able to get the shares, but still get it for a discount. So you can do that. Once you take ownership of the shares, then you do what is called the covered call. The covered call is basically renting out your shares. You're using your shares as an asset, as like people use their house as an asset and they rent it out for on a monthly basis, or they rent it out through Airbnb, something like that. You're using your shares as an asset. You can do that if you have at least 100 shares, which is considered a standard lot. If you do that, you can rent it out on a weekly basis. You can rent it out on a monthly basis. You can rent it out on a yearly basis if you wanted to. But the normal way of the wheel strategy is doing it on a monthly basis, around 30 days. But on the safeguard strategy, you can do it on a weekly basis if you like. And this is what we're showing here. You can do the covered call and you can sell. Normally you're selling it something out of the money, but you can also sell it in the money if you wanted to. In this example here, someone's going to pay you $55 to have the right to purchase your shares at 152 and a half. If it goes up past 152 and a half and it expires above that, you're going to make $280, but your shares are going to be sold away at that point. That's fine. You've made a profit. You did what you wanted to do on that covered call. You've made a profit. Selling of the naked put is bullish. The selling of the covered call is bullish. Both strategies are bullish. You want it to go up. Do not be mistaken and think that you do not want it to go up if you are the seller of the covered call. You do want it to go up. Okay? But some of the drawbacks of the wheel strategy is that if you sell that naked put and it drops too much and your cost basis is really out of line. So let's just say you sold it at this 150 and your cost basis was 149 and it drops to 140, right? Well, your cost basis is off $9 or 9 points. Well, that's a big difference. So then you have to kind of work that back. And the wheel strategy doesn't tell you really how to do that besides selling covered calls. But what if you sold a covered call at this point and your cost basis is 190, excuse me, 149, and it is trading at 140? Well, you're not going to be able to get any premium by selling something at the 149. I know it's showing you getting premium now, but if that was the case, you wouldn't be able to get any premium. So for example purposes, let's say your cost basis in this example, your cost basis is 160. Well, you're not getting any premium at 160. So if you sold it because you're not getting any premium at 160, you decided to sell it at 150, and then as it say Walmart jumps up or whatever stock you're trading jumps up at that point, and then your shares are taken away at the 150, but your cost basis of 160. Well, you're still down 10 points or $1,000. What do you do then? What do you do then? The wheel strategy is great. I love the wheel strategy in a bull market and in a market that's not dropping too much. But if you do it on a stock that drops too much, then it becomes a problem because your cost basis once again is too out of whack. The only thing you can do at that point is to be able to write down your cost basis. And we're going to be introducing the Trading Diary Pro here in a second, so you don't have to use spreadsheets. You can just download stuff, and you can just download it into the software that will keep a record of what you need. I was talking to the owner of Trading Diary Pro last week, and I'm creating some videos for it now, and we're going to have him come speak to the group next month on a Wednesday in June, to be able to answer all the questions that you guys might have about the Trading Diary Pro and how you can keep a record of your trades and things like that. But until then, or if you don't want to purchase Trading Diary Pro, you write down your cost basis. So if your cost basis is 160 and you had your shares were taken away at 150, you're $10 down. So what you can do at that point is to say you sell something that's at the 140, 152 and a half, and you collect, just say for easy math, you collect $2. Well, now instead of your cost basis being 10, right, your cost basis is now going to be 8. And so you write that down and say, okay, my cost basis, I'm only down $800 now instead of the $1,000. And you just keep chipping away at the cost basis. And you just keep chipping away at the cost basis. And that's how you can overcome the most negative thing about the wheel strategy. And that's if your stock drops too much. Right? You're still going to be better off than the person who just bought the shares outright, but you don't want to get in a situation where the stock shoots back up and this happens and your cost basis is still real low and you can't get it back, or you're afraid that you can't get it back. Just keep chipping away at the cost basis and you'll get back to even if you did it on a good company or if you did it on a stock index. All right, so that's the wheel strategy. And you normally, once again, start the wheel strategy at selling of the naked put. Let's talk about the safeguard strategy. The safeguard strategy at the Dorian Way, we add two more strategies to it. Okay? We add what we call the collar strategy and what we call the bionic bull. The collar strategy is going to give you more safety to the downside. It's going to protect you more to the downside. It's still a bullish strategy, but it's going to protect you more to the downside to remove that huge difference in cost basis if you start with the collar strategy, if you execute the collar strategy. So for example purposes, let's say instead of starting with the naked put, you start with a collar strategy and you decide that you're going to sell the covered call and then you're going to take some of the monies. This is what a collar strategy is. You sell a covered call and you take some of the monies to buy a put. So let's just say you decide that you're going to buy the put here for anything less than like $56 or less. So if we buy this put here at the 147, then you'll see that someone's still paying you $21, $22 to be able to do this. If it jumps up past 142.50, you're going to make $230 in the next 7 days. But if it drops, let's say it drops to 140, like the example we were using before, well, your cost basis is going to be no worse than a little above 147. Okay? A little above 147, because you have this put here that is going to protect you. You can't lose anymore outside of once it goes past this 147. Just like you can't win anymore if it goes past this 152 and a half. So what you're doing is bracketing off your risk and profits, right? You're minimizing your upside and limiting your downside when you do a collar. And so this, when you going back to the basics of options, if you buy a put, it gives you the right to purchase or sell the shares at the 147. So it gives you the right to sell 100 shares. And when you sell a call, it gives you the obligation to sell 100 shares at the strike price. So you're offsetting your shares if it goes up, and you're offsetting your shares if it goes down. So that means you can't lose once it goes to a certain point, and you can't win anymore once it goes to a certain point. But this keeps your cost basis within a tight range, in that it doesn't get significantly out of whack when you're doing a collar strategy. When you're initiating with a collar strategy, you can also, if you do a naked put and your shares are put to you, you can also do the collar strategy at that point and not the covered call if you don't want it to. The collar strategy, in my opinion, is safer than a covered call strategy. Yeah, you might get less upside, but you're going to get significantly less downside risk when you're doing the collar strategy.
You need to own the stocks when you have a collar strategy.
Correct. You need to own the stock. So you can do this all in one trade. Most of the time on TastyTrade at this time, you can't. You have to do the covered call first and then buy the put, and then that is set up the collar on platforms like Thinkorswim and Interactive Brokers, and I believe on E-Trade you can do the collar strategy all as one trade. Okay? In TastyTrade they'll get there. All right. So this is the collar strategy. Now we also have what we call the Bionic Bull. One of the other drawbacks of the wheel strategy is that you never have unlimited upside. Right? You never have unlimited potential to the upside, because when you sell a put, the most you can make is what you sell the put for. When you sell a covered call, then you are limiting your upside. You never have unlimited upside. Well, with the safeguard strategy, you can do what we call is the Bionic Bull, and that's going to give you unlimited upside. So for example, if we sold this 150 put and we take some of this $106 and we buy a call, well, then that's going to give us unlimited upside. So in this example, we can buy this call at 152 and a half. Well, for the next 7 days, and you can do this for 30 days, you can do this for 1,000 days out if you wanted to, but for the next 7 days, we have unlimited upside potential, and someone's paying us $63 to do that. That's what we're receiving, and we still are getting it for less than what it's currently trading at. We're still getting it for a discount, right? 63 cents less than what it's basically currently trading at still, and we have unlimited upside. When you buy a call, it gives you the right to purchase at a certain strike price, in this case the 152.5, and you have theoretically unlimited potential to the upside. When you sell a put, you have the obligation to purchase the shares at the strike price. So it's still doing something like the wheel strategy when you're selling just a naked put, but when you sell the just a naked put, you only have what you can make on that put that you sold. But if you turn it into what we call the Bionic Bull and buy that call for free because someone's paying you some monies and you take some of that to buy the call, then you can have unlimited upside when you do this kind of Bionic Bull. All right, so let's now go over to this Thinkorswim platform and let's look at executing this kind of collar strategy or a deep in the money covered call. We have the 100 shares in this account right now. We did a collar on it, and the options expired today. Walmart, since we did this, has dropped some, so we're down a little bit on since we did this last trade. But both of these options where the stock is falling has fell between the call and the put, so they're both going to basically expire worthless. well, the put is going to expire worthless. The call we've made money on. We've lowered our call spaces on the call. But what we're going to do is trade this and kind of reposition the trade. So we're going to go back and we're going to do the 7-day trade here, and then we're going to hopefully be able to still get that for credit. I'm going to go back over here, drop this really quickly, and then go over here and move this, and then sell the 152 with 7 days to go. And that's going to give us 47 cents. I'm going to buy the 147. It's not going to give us a lot, but it's 7 cents there. And we're going to send that, and then we're going to see if we can get filled. So we're going to give it about 5 seconds. So we just got filled on that trade. So not bad. So we'll take it. It's just a small credit, nothing extraordinary.